Research at Citi, Markets Edition.
Welcome to Research at Citi, Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Dirk Willer, Citi's Global Head of Macro, and with me today is Adam Pickett, our London Macro Head. Welcome to the show, Adam.
Thank you so much for having me, Dirk.
We are recording this podcast at 9 a.m. on Monday, January 26, 2026. Coming back from Davos, there's much to discuss. The two big themes were geopolitics as well as AI. Both are very market relevant. So what did we learn? Let's start with geopolitics. Going into Davos, the key question was how the Greenland crisis would play out. In the end, it appears that the maximalist demands by the US administration for Greenland were once more part of the art of the deal, even though some European resistance and a weaker equity market may also have contributed to the US administration paring down its demands. Still, to some extent, the damage was done, as Canadian Prime Minister Carney summarized in his speech, where he suggested that middle powers like Canada, but also like Europe, should stop relying on the old rules-based global system for protection, and instead they should cooperate strategically rather than relying on old alliances. Now, the interesting market aspect of all this was that at the height of the crisis, we saw a fall of the S&P combined with a weaker dollar, somewhat reminiscent of the April 2025 behavior. This correlation used to be unusual, but is now more common when US exceptionalism is questioned. Even more importantly, as the Greenland crisis faded, the S&P recovered, but the dollar did not. On the contrary, the euro kept moving stronger. This is interesting and may well set us up for more dollar weakness. Adam will discuss the issue more in depth. The other big topic in Davos was AI. Many of the large AI companies and some of the star researchers were in Davos and opined on the geopolitical aspect of AI, the path to monetization, and the time it would take to reach AGI, artificial general intelligence. We think for equity markets, the AI debate is more important than geopolitics as it impacts the earnings power of the corporate sector much more directly and faster. In particular, strong earnings this earnings season would go a long way to calm investor sentiment. Furthermore, if AI is fast in impacting the labor market, it has important implications for the Federal Reserve. Only if AI is going to meaningfully contribute to a weak labor market can cuts be easily justified, no matter who the new FOMC chair should be. Such cuts are part of the bullish equity narrative too. We at Citi still see cuts, even though not this week. Given that the AI story seems on track, and as we do expect some Fed cuts, we stay the course, long equity markets, even though we would also note that some of our more tactical signals suggest short-term caution. Adam, the team has done a lot of work on the dollar and diversification flows. How do you see this in the light of the latest developments?
Thanks, Dirk. Our immediate-term view that we put out last year was that the US exorbitant privilege is increasingly an equity trade, not a treasury trade, which is to say that the traditional relationship between equities down and dollar up, we were calling into question. And so it's not too surprising to us that we've had another example of that, but it does make us want to dust off our post-Liberation Day playbook. Now, that's a good narrative. We had dollar down on the tariffs. We didn't really have it recover when the tariffs got taken off, and then dollar down again quite broadly across G10 with the risk rally to the end of the week. So that's one tick. The other tick in that box would be more obvious examples of real flow rotation rather than just the dollar weakening. And some of these metrics are longer term, hedging flow indicators from the Scandinavians, bigger picture equity flow and allocation data. But one thing we can track a little bit higher frequency using ETF flow data is a proxy for cross-border equity flows. Those have started to move in favor of Europe, so Americans buying more Europe and Europe buying less America in equity space. And ultimately, we think the bar for diversifying has been lowered last year simply by returns. In 25, diversifying slightly away from the US was a brave decision. The US performance the year before had been very strong relative. Now we're coming off one of the worst years the US has ever had in terms of local price performance versus the rest of the world. And that was even worse when you took FX into account. So, we're not for 1 minute saying you shouldn't be overweight the US. It's just that there are some rest of world opportunities now to be buying into. And so that's the way that we're allocated. We're overweight the US, but we also have China and Japan. But in FX, I think they're a tentative sign that some of this policy uncertainty and some of these equity fragilities can also be dollar negative. So we're long euro, targeting a move towards 121. Dirk, elsewhere in FX land, the yen move has been pretty stark. How are you thinking about all things Japan?
Yeah, that's the other key story that coincided really with the whole Greenland issue. The last leg of the Japan story was, of course, the rising likelihood of snap elections. And indeed, they're now going to take place on February 8th. Going into the election, 2-year holiday for VAT on food items has been suggested by the Prime Minister. This added to fiscal fears that led to higher rates in the context of a steeper curve, to higher equity markets, and to higher dollar yen, which was driven really by term premia. Now, we had actually taken off our long-lasting JGB underweight last week as the likelihood of intervention in both dollar yen and JGBs was clearly rising. Since then, JGBs rallied as did the yen, partly because the Fed has been checking rates on dollar yen. Now, this could be because the Fed acts as an agent for the Japanese Ministry of Finance, or because joint intervention has become more likely. We do not know yet how that will play out, but I have a few thoughts that I want to share. First, bilateral intervention is a lot more effective than unilateral one. So that will be important to watch. Second, intervention usually just builds a bridge to a situation when fundamentals change too. So if fundamentals don't change, the impact of intervention is usually somewhat short-lived and can be measured in days or weeks rather than in months. So what could change fundamentals, or what could make sure that dollar yen keeps going lower? One, again, as I mentioned, would be bilateral intervention. That would be really quite powerful potentially. Second would be better fiscal. If it turns out that the fiscal concerns are somewhat overdone post-election, that would clearly help. Or third, a more hawkish BOJ that could control term premium. It might not necessarily lead to lower rates in JGBs, but certainly to lower term premium, and that might also help. So a lot of uncertainty whether any of those three factors can be achieved or not. So for now, I think the market is correct in treading a bit more carefully and unwinding some of these stretched positions. But Adam, overall, I would say it's not just Japan. Rates have become more difficult to trade. There's no clear-cut easing cycle anymore ongoing in many countries, which is usually the easy money. And so the team has focused much more on relative value in rates. Walk us through your thoughts on that side, please.
Sure. So it seemed to us like last year when some front-end curves repriced from cuts to hikes, it dragged a lot of other G10 curves with it. And we thought maybe that was a little bit over-exuberant. So firstly, we looked at historical precedents for hikes. And actually in the 90s, the gap between last cut and first hike was measured in single-digit months for a lot of DM, and we think that we're probably closer to that type of backdrop with inflation and shorter growth cycles than before. So can we get hikes this year? Yes. Can we get hikes broadly? We don't think so. In Australia, yes. In Japan, yes. So we're paid Aussie versus CAD. We have been since mid-December out to Z6. We think that still makes sense, given all the strong labour market data out of Australia, plus the additional threat of tariffs in response to Carney's speech. And elsewhere in Norway and Sweden, again, looking at relative inflation profiles, you've got inflation in Norway that's typically consistent historically with the start of hikes. And in Sweden, that's nowhere near. You've got negative inflation deltas. So within the G10 space, we think there's plenty of opportunities to fade this idea of sort of synchronized hiking cycles.
Thank you, Adam. So overall, we believe that the fact that the Greenland issue has quietened down does not necessarily mean that the dollar weakness is behind us. For equities, the AI story is more important than geopolitics, and we stay strategically positive, even though some of our short-term tactical indicators are somewhat less constructive. Thank you for joining us for today. The episode was recorded on January 26, 2026, and I'm your host, Dirk Willer. For more details, Citi clients can check out our report on the Citi Velocity portal. Next week's Research at Citi Markets Edition will be hosted by Beate Menthe, Citi's Head of Global Equity Strategy. And be sure to watch our Research at Citi podcast, which you can view on the same channels. The macro strategy team will be back in 2 weeks. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.